So today's topic is one that's being reported on a lot, and it is ESG. And globally, ESG assets are on track to exceed $53 trillion by 2025, more than a third of the 140 trillion in projected total assets under management. So to say that asset managers cannot afford to ignore ESG is an understatement. I have with me today Leslie Nicholson, Chief Product Officer at BITA. BITA is an index provider that is making indexing more accessible to a wider audience than historical indexers by offering customization at scale and tools for clients to build and test their own indexes and rule-based portfolios. Thanks so much for joining me today, Leslie.
Hi, thanks for having me, Anne Marie. I'm happy to be here.
Great. Let's start by talking a bit about BITA's history, and I'd love to hear a little bit about the types of clients you work with.
Sure. So we work with institutional asset managers globally, Europe, North America, Australia, and we also work with financial advisory and online brokerage. So our approach is that we offer clients solutions that they can work with in-house to do index creation, index testing, and we also are a services provider. So we can provide those clients with everything they need in indexing from beginning to end, index creation all the way to index administration and daily calculations. So this is how we're offering index solutions that and rule-based solutions, they're not all indexing, for every type of investor need, from institutional investments and funds and ETFs to financial advisory and brokerage, where clients are starting to need more rule-based solutions and direct indexing type solutions.
Yeah. So it sounds like customization is a key part of what you guys offer, but is there anything else you'd like to highlight that is different about your approach?
Yeah, so we basically make rule-based investing seamless in that we have all of the building blocks for the rule-based investing at our fingertips. Every day we're updating and we're bringing in the more current approaches to how clients are looking at their investment criteria. So we have thematics mapped out, continually doing more current research on the thematics. And we do the same thing for ESG. So ESG, sustainable investing, responsible investing, so many ways to describe the same term, but we have all of the building blocks such that if clients can ask us for any type of rule-based investing that involves ESG and sustainable or responsible investing, we have those building blocks at our fingertips to build the rule-based solutions and to do it in a customized way, depending on what the client's looking for. So for example, regulation and changing investor philosophies with ESG is something that we see as a major theme. And we aim to keep approach that in a way that we consistently have updated information so that we're not developing a product when a client asks for it, but we already have the building blocks to build that rule-based product at the time that we might, be ready for it before the client has even asked us for it. And, in the past 5 to 8 years, ESG has really been a catalyst for the rise in customized investing, I think. New funds are being launched for every different style. Customized approaches are being made available outside of just more ETFs and differentiated ETFs. But investing such as direct investing, which allows clients to be making their own decisions on their rule base. And this is something that really differentiates us from the other index providers that are doing some of the more traditional types of rule-based investing. And to apply an ESG screen to that is a lot more straightforward and a lot simpler and less complex than what we're doing and what we're offering to our clients.
Great. And maybe you could just highlight kind of what the major different types of ESG investing criteria are, and also maybe talk a little bit about how prevalent each of those components are and any trends you might be seeing with respect to each of them.
Yeah, sure. And that's a big answer, so I hope you don't mind if I talk for a few minutes.
Go for it.
So yeah, thanks. This is something I feel passionately about, and it's something that really is rapidly changing. So it's important to keep on top of it. So I would say I would sort of divide ESG and responsible investing into three major areas. The first we would call negative screening. The second we would call positive screening. The third we would call green revenue investing. And so the first one, negative screening, is, it's probably been around for the longest. It's things like excluding specific types of products or specific types of revenue lines from a portfolio or from a fund. So no fossil fuels, no guns, or, in the case of aerospace, there might be certain types of weapons that need to be left out of a fund or an ETF. And that's something that you also see on a faith-based level. You hear about Sharia funds being faith-based for Muslim values. And, we saw it, I think probably the most prevalent type of negative screening that we started to see was in about the 1980s with tobacco being screened out of portfolios. And companies then realizing they needed to report what portion of their revenues were in each of those types of buckets that were getting negatively screened out. And then the second type, positive screening, is a way of screening for a minimum threshold for any ESG measure and allowing only companies that meet that hurdle to be included. And so E, of course, stands for environment, S for social, and G for governance. So you can use those three as the overall way to look at positive screening. We see the most positive screening happening in climate and emissions, so in the E of ESG, and that's something that's also the most objective to track. And that's something that's a tenet of our philosophy at BITA, is that we are objective in our ESG offerings. So we don't have an ESG score. We're not taking E, S, and G and lumping them together. We're viewing them very separately and using them as a rule base very separately. For example, positive screening could be having a maximum emissions per revenue dollar as a rule for that ETF or that portfolio. There could be a minimum threshold for women or underrepresented people in management or on the board. Governance measures can also be included, labor measures, country of operation. So those are all positive screenings, which then allow companies above the threshold or within those regions to be included. And then finally, green revenues, or sustainable. Some people might call this sustainability-based investing, which is to invest for sustainable revenues specifically, which is, if you think about it, it's really just an even more stringent positive screen, but you have a threshold by which 50% of a company's revenues have to be making a positive difference in climate change, or 80% of a company's revenues need to be related to climate change plus social issues plus solutions for clean water, for example. So they can be very specific or they can be very broad. And then I think, later in the conversation, I'll mention a little bit about the EU taxonomy, which is something in Europe, a regulation that's making responsible and sustainable investing, green revenues, in other words, green revenues, a lot easier and simpler because it's requiring that companies report their revenues in that fashion.
With respect to all of the components, are you seeing, are most firms trying to capture all these three components, or is it often they pick one or two, or what is typically done in the market?
Yeah, I mean, that's really the most important question, because it's what clients are looking for is driving what's launching, and it's driving what we're doing as well. So 2022 was a year for quite a lot of ETF and fund launches in all types of, I would say, the second to positive screening and sustainable funds. Negative screenings have been around for a lot longer. As I was mentioned, they sort of started in the 1980s. But as far as trends and what we're seeing, we've seen so much customization in these rule bases. The positive screen, well, even the negative screenings have gotten very granular in what clients are looking for. So most of our indexes that we're launching have some sort of negative screening. And then as far as generally speaking, index launches, at least half of our index launches in 2022 were positive screenings or green revenue based entirely. And some of them were also norms based, which is a type of positive screening. But a norm would be Paris climate goals, European taxonomy revenue classifications. They're very objective, they're very straightforward, and they're also reported by companies. So for the norms-based screenings, it's making things easier for the investor to get the information that they need. We do a lot of additional research beyond what's being directly reported by companies, but we look deeply into their management discussion and analysis and their annual reports to really understand what they're doing in these spaces. But with some of the norms that are being released and in some cases required, like the European taxonomy, large cap companies in Europe, for example, are being required to report their green revenues with a very specific classification. So the more we see those roll out, the more straightforward it will be for investors, whether institutional or retail investors, to be asking for these types of objective measures to be included in their investments and to be the base for some of their investments, in fact. And I would point out, actually, this is a good time to mention that Europe has really been a leader in these norms and in regulation around reporting of whether it's companies reporting their revenue or their emissions, or whether it's the investment funds themselves having to report the statistics of their funds and how those funds are meeting emissions goals and targets as well. So Europe has been a leader. Canada, in North America, Canada has been a leader versus the US, not only in investing in the different types of ESG investing, but also in the regulations on E and S and G reporting as well.
Oh, excellent. And turning to direct indexing a bit, why is it such a big growth area?
I think it goes back to customization. I mean, direct indexing is essentially describing a way of, it may be starting from a base of a major index like the S&P 500, or it may be starting from a much larger investment base, but it's essentially putting one's own rule base onto the public equities market, and it can involve other asset classes as well. But for the purposes of this discussion, we're talking mostly just about equities. So direct indexing allows for customization to say, maybe I'd like to see the largest 500 companies globally, and I'd like to put another rule base on it. And there might not be an ETF that's offering that investor exactly what they are looking for in their rule base, because they may want to filter out for some negative screens, and they may also want to, make sure that they have companies that are only meeting a certain threshold for their employee satisfaction or for their labor standards. So direct indexing allows for that to happen, for all those rules to be completely customized. And then direct indexing also allows for another layer, which in North America has really caught on, which is tax loss harvesting. So tax loss harvesting and maximizing the use of those tax losses. And that's a very individualized portfolio approach, or a very individualized approach to an ETF. So that has earned this title, direct indexing, which essentially is kind of a shorter name for saying, individualized rule bases. It can be, and I should add that it's being made available with, on a portfolio approach, but it's also being made available on an individualized approach. So there are some large online brokers out there that are offering portfolios that a client can invest in the entire portfolio, which means that that client can actually pick and choose if they want to invest in all 100 of the securities within that portfolio, or they can even just leave out one. And that allows them to have their own individualized approach to that portfolio, while that brokerage house has offered, 100 sort of model portfolios. And then they can allow the direct indexing to occur on top of that. So I think direct indexing is this all-encompassing term that now encompasses all types of model portfolios and example portfolios, and then drilling that right down to the fact that individuals can now, if they're taking a model portfolio, they can make their own changes to it, which is a very different thing from investing in an ETF.
Like with regards to the scale of doing something like this and customizing it, it sounds like there, from a minimum investment perspective, you don't necessarily have to have a huge amount, but can you comment on, is there such a thing as like you have to have a minimum sort of size for this approach to work, or how do you look at it from that perspective?
So a size approach for direct investing, there's not really, I think for model portfolios or for specific portfolios that might be being put together with specific rule sets that, a large brokerage house has so much data that's coming in from what their investors are investing in, and they can assess, what the trends are for their investment base. So they can actually take that data and they can say, okay, well, here are the 10 most common portfolios that we're seeing people move into. Like, for example, in Q3 of this year, Q3, we saw for sort of the third month in a row, a real slowing in movement into ESG funds. And that's something that large brokerage houses would be able to see those trends, and they can create their own new portfolios based on that data that comes in. So it allows them to offer clients, I know that some clients can pay for a flat fee, for example, for their entire portfolio to be able to utilize the model portfolios that brokerage house might be coming into and apply direct indexing. So there wouldn't be a minimum investment size because that client is actually doing the trading in their own portfolio, but it's being made available by solutions like ours that are underlying these portfolios, allowing for the rule bases to be consistently applied. And so, a client can, if BITA's BITA Core is underlying that investment solution, it would be rebalanced, at whatever interval the client chose. And the amount that is being invested in it is not affecting the fact that it can still be rebalanced every quarter based on the rules that are being applied to that portfolio.
Are you seeing brokerage houses kind of offering that to like their ultra high net worth clients or family offices, or sort of any insights on who's actually sort of where's the demand for these products coming from, and what types of clients are ultimately investing in these strategies?
I would say it's across the board. It's in some cases it's being rolled out to financial advisory first. So advisors are able to use these tools to create individualized portfolios for all of their clients. And then with retail brokerage and do-it-yourself online investing, it's seen less of a pickup. So it's been rolled out, I think, more widely to financial advisory and across all of the advisors at by one head office, and it's been a little bit the smaller online brokers don't have as many of these model portfolio solutions. Some of the larger brokerages were the leaders in that, and I think we'll see it roll out to more over time. Absolutely. And the I think one thing to add about the rule-based for ESG, one trend we've seen is that ESG scores are becoming less and less focused on. They're being viewed as more subjective, And I think that the whole industry, we know and trust that over time, ESG scores will become more like credit ratings, and they'll become a lot more straightforward and based on data and not on they'll be quantitative and not qualitative, right? Until that kind of sorts itself out over time with the feedback loop that comes from global investors, I think ESG scores are being used. They kind of had quite a ramp up in popularity, and then they saw kind of a drop in popularity and some criticism towards them, which is why I think that they could see some improvements over time, but that could be a very long time horizon. And so what we do is we take an objective approach, like I said before, in terms of only using data that's available, and in theory it's already reflected in the share prices of companies, because it is public information. We don't have any non-public information, but we're trying to synthesize the public information in a way that allows us to offer our clients more information by synthesizing it. But then what we can do is actually provide all of that data in the forms that we can put it in to make it, to normalize it across standards, to make sure that it's all, completely objective and normalized. Then it can be used in those rule bases. And so what we've seen is, as a trend across both institutional and investing through retail investing and through RIAs, is that you see less of a reliance on ESG scores and more of a reliance on these classifications that are completely objective and being reported directly by the companies.
Very interesting. So if we turn for a moment to the regulatory considerations and perspective, can you comment on just what you're seeing going on globally with respect to regulation and ESG?
Yeah, absolutely. So I mentioned the EU taxonomy in Europe earlier. In the US and Europe, there are two things in addition to the European taxonomy, which nothing with that kind of similarity in terms of classifications and revenue classifications on financial disclosures has caught on and really been put forth in the US. However, naming conventions are something that Europe has led on, and the US has absolutely followed suit. So just a month ago, the US had, it was brought to made official that funds have to have 80% of their investments in what they are named for, which seems like it should be an obvious, should have been already something that was implemented, but at the same time, until it's made a regulation, it's not gonna be 100% adopted across the industry. So now that's made official, and investors can be assured that at least 80% of the investments in that fund are what it's stated upfront in the title. And the interesting thing is, with ESG investing, the investor would still have to understand the details of what is in that fund, because by naming something ESG, as we've discussed, there's so many different ways to call responsible investing ESG investing, and what are each of those things? There's no exact definition of them. So for a fund to be named something that indicates that it has ESG positive, negative screenings, whatever it has in it, it's going to be still a requirement of research on the investor's part.
Do you expect that that rebalancing was going to occur as a result of that, or was it really like most funds were already loosely following those guidelines anyways?
Well, in Europe, there was kind of a rush on name changes to funds and reclassifications to the different levels that were established for what can be called, an ESG fund and what can be called a fund battling climate change. So they were very established in much detail and given 3 levels of classification. And you did see some downgrades, which probably isn't a fair word to use for it, but you know, funds that were previously stating that they were meeting you know, the second highest standard of ESG had to, you know, either they had to change their actual rule base or they had to change the classification that they were claiming that they were meeting, because when they, you know, when they went and compared to the actual new regulation, you know, they were no longer meeting the second hurdle and had to come down in the naming classifications that they could use. But at the same time, you saw a rash of that happen, but now investors have a much more clear understanding of what those 3 levels of ESG classifications are and what they can be assured if they see a fund that is stating that it falls under each classification.
Well, that's very interesting to see how that's evolving, and I'm personally glad to hear that things are getting a little more precise, because that's sort of been my experience with it as well. Is yeah, there's a lot, when there's a lot of subjectivity, there's obviously a lot of room for interpretation.
Right.
So yeah, absolutely. And then to get to this next topic, which I know much is being written about this, and a lot of debate is going on, but and again, the what you might be investing in could vary pretty substantially. But from your perspective, would you say, like, is there empirical evidence to support that an ESG focus leads to superior investment returns?
So the evidence is that in the long term, companies that are reporting and reporting that they are and are actually managing to their ESG risks and opportunities, in the long term, they do see higher returns. So the research that's been done shows that in a nearer term, the financial results of a company will exhibit that they are, you know, tightly, and they have a tight rein on their ESG risks, and that in the long term that is reflected in the company from an investment perspective, from a share price perspective. So, you know, for investors that are looking for immediate gains, there's not really any evidence that they can get that if they're investing in ESG, or if they're investing in companies that are specifically sustainability focused or even climate focused specifically. I mean, you will, like any sector, you will see jumps and rises at different points in time and for different reasons. But on the whole, the benefit in ESG investing, if you're looking at it purely from a returns point of view, is that you really have to be holding those investments for the long term in order to see those gains.
Yeah, and I'd also be curious, and I don't know if you guys would necessarily have this data, but from an investor perspective, are there sort of generational sort of trends? Like, is it, because it's often said that, you know, younger generations perhaps are more tuned into this, but any comments you might have on that from that perspective? Is that bearing out? Are there trends, or is it hard to say?
There certainly is a trend towards younger generations putting more portion of their assets into ESG as a portion of each person's assets. And of course, older generations have more assets because they've been saving for retirement for a lot longer. But certainly you do see ESG and sustainability investing catching on and being a solid principle of younger generations who've, you know, grown up with climate change, with understanding climate change and being taught climate change in school, and understanding, you know, the community and the environmental effect of business. And then, but you know, on an absolute level, it's the data is skewed because with older investors having more assets on the whole, the inflows into ESG are higher by older investors, but as a percentage of those investors' portfolios, you see younger investors with a higher portion of their portfolio being in something sustainable or ESG related and having screenings for their investments.
Yeah, interesting. All right, and we've covered a lot of ground already, but sort of aside from the things that we've already spoken about, are there other sort of big challenges that you face that just just make the whole process more complex?
I think one of the challenges we face is that I mean, we feel that we have done a really solid job in capturing some of what's very hard to capture in data and making it available for rule-based portfolios and allowing all of that customization with all of those different criteria that can be the rules of an index or a portfolio. But I think one of the biggest challenges is that when a new concept starts to gain traction, it can be very difficult to have something substantial to report on for our rule-based portfolios. For example, net zero is a real buzzword now, and companies are releasing what may or may not be reliable information on their net zero goals. I mean, they can state a goal, but until you have a few years of data, it's very hard for anyone to know whether they are tracking to that goal. So I think right now you have companies that have stated goals. Some of them are very assertive goals. You know, they're going to be difficult to meet, and we won't know how companies are actually tracking to these goals until we have a year or 2 years of data to understand whether they are. So I would say the biggest challenge is great ideas and excellent solutions for meeting investor needs are not always attainable immediately, you know, upon that idea arising. There has to be, for example, you know, we have some investment areas like subsectors that have a lot of traction and interest, AI being one of them, for example. And to try to build a large institutional fund off of a very small, you know, subsector that hasn't, you know, doesn't have the market cap yet. The trends that bubble up are not big enough to meet an institutional need, and so we try to find ways to be able to reflect those trends. Until the time comes, you know, a year or two in, where we have enough information to actually make the data into something meaningful and large enough for institutional investors.
Yeah, and I'd say that lagging effect is common for a lot of different things, right? So I can totally understand that challenge. Thank you very much for your time today. Really appreciate it.
It was great talking with you, Anne Marie. Thanks so much.